So what I want to talk about is just a little brainstorming session here to get an idea of where people's minds are in regards to your thoughts. So, especially for those people who have, an under foreknowledge, this thing is insane, an under foreknowledge of foreclosure, what are your thoughts on what caused the foreclosure process? What caused it? Like, how did we end up here? How did we end up in a state of economic crisis?
Loss of job, employers.
All right.
Employers.
Job loss. What else? Those are some of your guys' thoughts. What have you heard people say the reason why we ended up in this crisis? Is there a difference? Is this what you hear? Or do you hear different things?
Well, medical expenses.
Is what you hear? And I'm not talking necessarily about clients. I'm talking about the public. Like, what do you hear? What do you hear the public saying the reason why we are in this economic crisis? So what you'll see is there's a lot of things you're going to learn as you start talking to clients about what caused us to get here, what caused people to get here. But then when you go out to the general public who doesn't work in this field, there are still some other perceptions about it. Not that necessarily these things didn't occur. Were there some financially irresponsible people? Of course, there always are. But there are in good economic times, there are in bad economic times. Did banks make mistakes? Well, yes, I'm all for that. I would probably put that over here. But yeah, and there's not as much, it's not required that everybody receive homeowner education. Some people get it, some people don't. Depends on what kind of loan program you are in or not. But there is a different perception about what caused it in the general public. I will tell you that from what I hear, the general public, and I usually mean people who have not struggled financially, really believe that this is a key thing. They really feel that a lot of people made bad decisions and bought too much home. That's what you're going to hear. They think they bought too much home. They don't think that they were preyed upon with a predatory loan, that they were given a second mortgage, that their home was overappraised by an appraiser who was in cahoots with the lender, who got a fax beforehand saying, I need this appraisal to come in at this, hint, hint, to make the deal go through, and magically the appraisal comes back at exactly that amount. You'll find a lot of this. And once you start talking to people, you're going to hear a lot of medical stories, job losses. I was told I was going to sign one thing, and when I showed up to closing, I was signed another. And I was told, if I didn't sign those documents, that, I could be sued. I mean, there's just a lot of things that happened over the years. And I would say that this actually happened in a certain order. And that's what I'm going to talk about here, is that we started out in one phase initially. And again, this is my historical perspective that I look at. Initially, when I started in 2001 working on this is what I heard, predatory lending. I mean, everybody who was coming into my office was telling me stories of, I sat down to close on my house, and I was told the loan was going to be one thing, and when I sat down to close, the documents were said something else. And I was told if I didn't sign, I could be sued, that I had already signed the purchase agreement, that I was in it contractually, I could not walk away. People were coming in with the adjustable rates, the ARMs, and they had what was called a 2-1 ARM. So a lot of people were getting mortgages to where the interest rate was great for the first 2 years, and then after that, it could start adjusting. And we're talking major adjustments. Every 6 months, it could go up 1 percentage point. I mean, things that right now, if people were to see those terms right now, they would freak out, because now those things seem so out of whack because they wouldn't be allowed nowadays. I mean, now the education level and the conversation in the public is such that those things, you don't see them because a lot of those lenders had to be shut down. But that is what we saw on a regular basis. That is what people were having. And I will tell you, in Grand Rapids or Kent County where I worked, I could tell you the neighborhoods exactly where all of my clients were coming from, because they were all coming from the same neighborhoods. I mean, there was just no denying that these groups had been preyed upon specifically because of where they lived. So predatory lending was big when it began. However, that changed. And I would say that change probably happened, I would say 2005, 2006. is when we really started to see the flip, at least over in Kent County, to where predatory lending started to not be the regular thing. All of a sudden we had the car manufacturers shutting down. And then when we had the car manufacturers shutting down, we had the parts suppliers shutting down. And then we had the parts suppliers shutting down, then I ended up with the car dealers in my office. I mean, you could see the train of people. It started at the plants, and then it started at the parts factories, and then literally the owners of the dealerships were in my office, because it just happened and trickled up the chain. So unemployment and underemployment really became big determining factors, and it was really what flipped, because truthfully, I would say by 2007, 2008, all of those adjustable rate mortgages and all those predatory loans had already been foreclosed on. You know, they got foreclosed on. What was going to happen to those loans happened. They all adjusted, they all inflated. That crisis happened. And had that been the only thing going on in this economy, you know, we may not have gotten to the point we got to. But then on top of all of that, our economy then crashes. And the auto industry and all of the other entities around it started crashing, and people started losing their jobs. And all of a sudden, people with good mortgages, people with a great standard FHA loan, came in at a low interest rate, low down payment, a MSHDA loan, were sitting in your office, and now all of a sudden, I have very little room to negotiate. How am I going to call the mortgage company and ask them to reduce the interest rate because it's not at 10 or 11 anymore? We're already sitting at 6. What are we going to do? This is already a great interest rate. There's no room to maneuver here. And that is where, when I talk later about the Making Home Affordable program, HAMP is what the most utilized program in that, is that even though with all the problems that HAMP has, the biggest thing HAMP did is it completely shifted the paradigm in the conversation of loss mitigation when it comes to mortgage companies in this country, I mean, that program in and of itself has completely shifted that paradigm. So for whatever the problems are, I will be forever indebted to that program for the conversation shift that it created. And I think historically, that program will be viewed as a life-changing program, I think, historically. I think historically and with perspective, it will be viewed as a huge program that helped save many, many people. So some statistics that I want to talk about. Do I start with the good news? Yes, I do. Okay, I always like to start good news. That's always good. So in 2013, Michigan's foreclosure rate dropped by 0.5%, according to CoreLogic data that I was looking at the other day. Michigan is no longer in the top 10. We were number 17, actually. So we have fallen out of the top 10 states for foreclosures, which is good for us. The bad news is that in 2013, almost 20% of our home sales, though, were for bank-owned homes. So what that means, even though we have fewer new foreclosures happening, our existing foreclosed pipeline is big. There are still a vast number of homes that have been foreclosed on that are still sitting there. So the trickle into the pipeline is slowing down, but the people who have been foreclosed on, it's still large. I mean, 20%, that's just huge, of our home sales were already foreclosed bank-owned homes. And then this is back in 2003 data. I'm not for sure. I looked for the 2014 one and I couldn't find it. But last year, over a third of Michigan mortgage holders were underwater. You know, so values in certain areas are starting to come back, but in other areas they're just very, very slow to recover. It's just going to take a lot of time. It took a long. I mean, we've been in this crisis for years, and it's going to take us a long time to get out. This is nothing that can be corrected overnight, especially when it comes to home values. I mean, think about how legitimate home values are established. Legitimate home values are established by what your neighbor's home sold for. So your home is always worth what your neighbor's home sold for. Well, when I tell you 20% of the sales were of foreclosed homes, it's going to take a long time to get your value to come back when a lot of the comps are a foreclosed property, and foreclosed properties naturally sell for less. I mean, they're considered distressed. Even if they're in good condition, they're considered distressed, and people expect to be getting some kind of deals on them. So it's going to take a while to recover, and that underwater number is not going to be able to recover until the percentage of foreclosed homes being sold decreases, because that will naturally keep the market low. So just some perspective as to what this state has been through. Michigan lost 500,000 homes since 2005. And this is as of 2013, so the number is actually higher because I don't have 14 numbers in here. That's nearly twice as many homes that were destroyed in Hurricane Katrina. And an average of 4.5 million households. That means we lost 1 in 9 homes to mortgage foreclosure crisis since it began. So that is a large number of homes that have been foreclosed on in this state. So let's get into some terminology and kind of talk about what kind of terms you're going to be hearing, the terms that get utilized. So the first term that I want to talk about is servicer. Servicer, investor, insurer. These are 3 different players in the mortgage world. The servicer, that is the company who you're going to be talking to, or who your client, when they call in and you say, who's your mortgage company? Whatever name they give you is the servicer of their loan, because that's the person who they're having contact with, who they make their payments to, who's calling them to say you're behind. That's the servicer of their loan. The servicer, however, may or may not be the investor or the insurer on their loan. The investor, that's the entity that actually owns the loan. So that's the person who actually has money at stake. So I'm talking about the Fannie Mae's, the Freddie Mac's. Banks can have their own portfolio. So it could be Bank of America could own the loan themselves. It doesn't happen as much anymore. Usually you'll see that with smaller banks, credit unions especially. Credit unions a lot of times, own some of their own paper. So that's the entity that actually put up the money to make the loan and who is setting the rules for that loan. So Freddie Mac, Fannie Mae, if it's one of their loans, they set the rules as to how that loan is supposed to be treated for the servicer. Because what they do is Freddie and Fannie, they don't have the staff or the resources to take the phone calls to handle payments. They outsource that. They outsource that to a Chase or an Ocwen or a Bank of America, and they pay somebody else to handle that loan and to handle the day-to-day operations. So even though you're talking to Bank of America is really probably not making the rules. It's probably Fannie or Freddie, someone else. There's also could be an insurer involved. Sometimes there's only an insurer. It could be an FHA loan on its own, or it could be an FHA and a MSHDA. They could both be involved in this loan. But the FHA, the VA, and some other private insurance companies like MGIC, they're insurers on the mortgage. So what they've done is they've come in for a loan that was loaned over 80% of loan to value. So if you buy a house for, let's say you buy the house at $100,000, the house is $100,000. If you come in and have to borrow any more than $80,000, you're going to need some kind of mortgage insurance, because you're expected to be able to put 20% down without having mortgage insurance. If you're not able to put 20% down, which a majority of people do not, then you're going to have, again, some kind of private mortgage insurance or an FHA or a VA or some type of insurer on that, where you're going to be paying a monthly premium on top of your monthly payment to the lender. The insurer is important because the insurer also sets rules for that loan. So FHA and VA will tell the servicer as well what they want done on that loan and what the options are to prevent the foreclosure. That's where the rules come into play here, is that they say what the options are when it comes to how to prevent the foreclosure. I'll tell you, the CFPB has set some standards for that. I'm not going to be going into a lot of CFPB regs today for a couple of reasons. One, those are really counselor level regs, and I don't want to overload your brains with that kind of stuff. But you should be familiar with the term CFPB, that's Consumer Financial Protection Bureau. Their regulations went into effect on January 15th of this year. Those regulations now nationally dictate, not for all lenders, but for many, when the foreclosure process can begin and what needs to be done during that foreclosure process. So even though FHA and Fannie and Freddie still get to have some of their own rules, there is a national body that's saying these are some of the bare minimum standards you have to follow. My somewhat pessimism on that, I love the fact that we have the CFPB who's setting those standards. My pessimistic view is really those standards, a lot of them are rules that were in existence before and who weren't followed. So I'm a little nervous as to how well they're going to be followed now because we've just put them in writing somewhere else. And the CFPB hasn't been given a very big stick. So I'm always nervous when we have a regulator who is allowed to create regulation but not given the stick to enforce it. So what we have yet to see from the CFPB is how they are able to enforce the regulations they've put out there. Like I said, those regulations went into effect on January 15th. We will start seeing lawsuits soon, and a couple of them have started as to whether or not lenders are following the CFPB, and those lawsuits will really show us what kind of stick we have or do not have when it comes to CFPB regulations. When you talk to a lender, you can ask who the investor is. Fannie and Freddie have lookups online. If you go to their websites, you can look up right online if it's a Fannie or a Freddie loan. So those are key terms to know: servicer, investor, and insurer, and understand that if the servicer is not the investor or the insurer, they're actually following the rules of somebody else, in addition to the CFPB regulations now.
Trot puts on their letters who the investor is. I wish all the others would.
And that's new for Trot. Trot hasn't always done that. Trot only does that now, I think, because Trot's tired of getting calls asking who's the investor on this loan. But yes, it'd be nice if all of them did. Other terminology to know: borrower, that's obviously the homeowner. That's the person who signed the debt. Understand that one of the frustrations that you will run into is that spouses are not always co-borrowers. Even if the one spouse says they had to sign something, if you're married at the time you take out a mortgage loan, you both do not have to be borrowers, but you both will have to sign something, because a spouse always has to give permission for joint property to be mortgaged. But that does not mean you are a borrower on that debt. So some of the frustration that we run into is that husband and wives very often just get used to being able to interact on each other's stuff without issue. You will not be able to do that when it comes to mortgages. If they are both not on that mortgage, only the person who's on the mortgage can sign the authorization. That is the person who has to be at the meeting. So when you're talking to somebody and you're doing your intakes and your screening and stuff, you need to be asking them, are you on the mortgage? You know, do the statements come in your name? If your name is not on the statement, most likely you are not a borrower on that debt. You may have permission to talk. You know, your spouse, the borrower, may have given you permission to talk, so you can talk back and forth with the mortgage company, but you can't sign the authorization. You can't give anybody else permission to talk. So whoever is the borrower must be the person to come to that meeting, or else that meeting will be very difficult to be productive, because no paperwork or authorizations will be able to get signed for the counselor. So you need to make sure that who's ever on that statement is one of the people who's showing up to the meeting at least. And then it also comes into play that if somebody else had another family member sign the loan with them, that person's information, they're going to need to play a role. So if you had mom, dad, aunt, uncle, in your mind co-sign, your mortgage with you, they had better be on game for whatever you're trying to do to resolve this delinquency, because their information will be necessary. And that gets tricky because sometimes people don't want the other person to know what's going on. They're trying to resolve it on their own. Not really going to be possible, because signatures will be needed from all borrowers. If you're going to end up doing a modification to a loan, you can't make a modification to a loan without both borrowers agreeing and signing. So the mortgage, that's the legal document that secures the loan, using the home as collateral. And then the promissory note, that's the legal contract between the homeowner and the lender. So when I say a spouse may have signed one document, the spouse may have signed the mortgage, giving permission to use that joint marital property as collateral, but they may not have signed the promissory note, which says, I'm legally liable for this debt. And if you are not legally liable for this debt, then you are not able to talk, negotiate, give permission for anybody else to talk and negotiate to that mortgage company. Default. This occurs when the mortgage is more than 30 days old. It's just a term that you'll hear the mortgage companies use more than general people, but default. And then foreclosure. That is the legal process used to take possession of the house. So the reason why I specifically define these is because they get thrown around interchangeably by people. People will call up and say, I'm in foreclosure. And my thing always is, really? Have you gotten a letter from the attorney? Well, no, I'm just 2 months behind. Okay, then we're not in foreclosure yet. So understand that words become very important, and that understanding where somebody is in the time frame of the foreclosure timeline, using these words properly, will help you define that. Sheriff sale, that's the actual date of public auction. Michigan is a non-judicial state. There are two types of foreclosure in this country, judicial and non-judicial. All states can go judicial. Only some states allow for non-judicial foreclosures. So you can foreclose on anybody taking them through the court system in any state in this country. However, there are some states, Michigan being one of them, who also allow you to do what's called a non-judicial foreclosure, where you can hold a public auction. Every county in this state has one day a week at the county courthouse where there is a public auction for mortgages. And sometimes there are multiple public auctions during the week if your county's really busy, but hopefully it's only one. For example, in Kent County, it's every Wednesday at 10 a.m. Every Wednesday at 10 a.m., Kent County Courthouse steps, they're auctioning off public mortgages. If your state allows non-judicial foreclosures, like Michigan does, a majority of your foreclosures will go that way because it's quicker, it's easier, and it's cheaper. Taking somebody through the court system, mortgage companies do not like to do because it takes a lot of time, it's very expensive legally, and it could expose some mistakes that they made. So it's much quicker and cleaner just to go through the public auction route and to never have a court system review any of your documents. So a majority of the loans in this state will go to public auction unless there has been a problem. For example, Trot, for as many foreclosures as they do, they actually catch some of mistakes that some of their clients have made and will tell their clients to take a loan through judicial foreclosure. If a client ever calls you up and says, and this goes for everybody in the room except for elder law, if a client ever calls you up and says, I have a summons notice from my mortgage company, a summons and complaint, you must refer them immediately to legal aid. A summons and complaint is the beginning process of a judicial foreclosure. So they only have so many days to respond to that. They are now officially in the legal system. You cannot talk to them or give them any advice because you are not an attorney. Anything you say about that judicial foreclosure process could be misconstrued as giving legal advice. So as soon as somebody acknowledges that they have a summons and complaint paperwork from the courts, then you need to refer them to legal aid or some other attorney because now they need legal advice to get that information. And depending on your relationship with the legal services, you may end up working in partnership with them to where you handle the negotiations with the mortgage company while the legal services takes it through the court system. But you need them to get to an attorney first before you do anything else on that loan, just to make sure that legally those documents have been dealt with properly and that they've gotten the correct advice about their timeline, because the timeline is very, very different in a judicial foreclosure as well. If a private person shows up to sheriff's sale to buy something at a sheriff's sale on the public county courthouse steps, the reason why this doesn't happen very often is because you have to show up with a cashier's check or cash in hand. So it is possible, absolutely possible. And they will have to put that money out, and then they will get it back if you end up selling it or something like that. You also do have the right, let me tell you this, I didn't specify this, but I should. You have the right to redeem the property. Technically, you can buy it back.
Right.
So if you were to come up with the cash yourself, you're most likely not going to get a loan, obviously, because of what just happened. But if you were to come up with the cash yourself, you could technically buy it back. I have had that happen once in 13 years, and that was on a VA loan. The gentleman only owed $6,000, and he came up with the $6,000. So he was able to come up with the $6,000 and he bought it back. So that is, that's allowed to happen. Sheriff's sale is a public auction. Anybody can show up at public auction and buy that house. Which is why I say a majority of these homes don't go for stated bid, is because of our redemption period. A majority of these homes go for full debt bid because your right to redeem is based upon the amount that it sells for at sheriff's sale. So if the mortgage company were to say, let it go to stated bid, and you owed them $100,000, but they're going to let it go to stated bid, and it were to go for open auction at $25,000, you could redeem that house for $25,000. Yes, they could try to sue you later for the $75,000 deficiency, but you could own that house mortgage free for $25,000. Because the mortgage is wiped out. Mortgage is done. Mortgage got foreclosed on. You redeemed it. You now have an unsecured debt, this deficiency for $75,000 they could sue you for, but technically you now own this house for $25,000. That's why they don't let it go for less than full debt very often, because they want to make sure that if you try to redeem it back, or if you try to sell it, that they get all their money back. The arm's length transaction comes in when we talk about short sales. If you want to try to sell it for less, during the redemption period or before the sheriff's sale. Anytime you want to try to get a deal on the property and sell it for less than what was owed, then the mortgage company is going to make sure that that's not a family member or friend or something. Redemption period. So I said that our legislature has attempted to take away our redemption period a couple of times, or at least shorten it. This is the time after the sheriff's sale. So the sheriff's sale is the public auction. That's what occurs on your county courthouse step. That is the date the foreclosure actually happens. So I always tell people, if we want to prevent the foreclosure, we need to prevent the sheriff's sale from taking place. After that sheriff's sale happens, yes, you will hear some random stories about people getting the foreclosure undone, and I'm not saying that hasn't happened, because I've had it happen a couple of times, but I'll tell you, in 13 years, I can count on one hand the number of times I've seen a foreclosure undone. So it doesn't happen very often. Your best shot at stopping a foreclosure is preventing that sheriff's sale. So the redemption period is the time after the sheriff's sale. So that really is the person's time to live in the home post sheriff's sale and to work on plan B, because keeping the home plan A has not worked. So you can still sell the home during this time. It's still the homeowner's right. It's still their home. That's a big thing that a lot of people don't realize, is that they can still sell their house. I always tell people, if you have equity in some parts of the state, people used to laugh at me when I say that, but there are actually some parts of the state where property values have increased. Kent County is one of them. We have certain areas, certain pockets of Kent County where home values have actually gone up quite nicely, and there actually is equity reestablished in some homes. So people, it actually is legitimate for them, if they get foreclosed on in some areas, to now say, oh, my home, I only owed $120,000, but my home right now could sell for $160,000. Quick, sell it, I tell them. You've got 6 months to get that $40,000 in equity out. So do it. This is your last chance, because once the 6 months ends, you've got nothing left. It also, though, if there is no equity, it's your time to live in the home, and I say that is your only silver lining at this point. Live there for free. Do not move early, unless for some reason you have to. But don't move someplace that you're going to start paying on, when right now you've been through the foreclosure. We can't undo that. Take these 6 months to save your money, to recover somewhat financially, the best you can in 6 months, and live in this house that you don't have to make a mortgage payment on. Land contract. These are coming up more and more often now, as we're seeing people who have been foreclosed on. A lot of homeowners want to remain homeowners. They don't want to go into a rental situation or an apartment situation. And one of the ways they're doing that is getting into land contracts. Land contracts are a different beast in and of themselves. They get foreclosed on differently. The terms can really be dependent upon who wrote the land contract. But really, land contracts are just a legal agreement between the seller and the buyer, where the seller is providing the financing and the buyer is making payments. It really kind of is this quasi, you own the home, but you're paying payments, to this person, kind of like a mortgage, but you don't have all the rights you do on a mortgage loan. If you have somebody who's in a land contract foreclosure, that will be going through the court system. The foreclosure process is a little bit different. It's almost like a repossession. It gets treated more like a repossession in the court process. I always think legal advice on land contracts are good, especially with the land contracts we're seeing now, because a lot of out-of-state entities have come in and written land contracts based on their state's laws, not on our state's laws. So I always like to have land contracts reviewed just to make sure the land contract was legal to begin with. And then if it is, then we kind of work out, your only options to work out with a land contract is with that land contract holder. So your options are as good as the person is who's negotiable. If that person's not negotiable, there's not really much you can do, because there is
Land contracts lately.
There is no step forward on land contracts. There is no modifications unless that person's willing to do anything. I mean, your options are only what that person's willing to offer. So land contracts can be difficult. If they paid it and they owned it, then they should have gotten a clear deed recorded. If they didn't get a clear deed recorded, then there's no proof that it was paid off and that they owned it. I mean, it really can, land contracts become really funny legal matters. I always like land contracts reviewed by attorneys just to see what's going on. Deficiency of judgments, that's the difference between the amount bid at sheriff's sale and the amount you owed on your loan. So this really, deficiency judgment really is, it answers that question when a person says, if I get foreclosed on, what am I going to owe? Are they going to be able to sue me? That's the deficiency judgment. And understand, a mortgage is not like a car repo. People are very used to car repossessions in regards to how you get sued later on. You know, for a car repossession, the bank gets your car back and then they sell it. And the difference between what they sell it for and what you owed is what they can still come after you for. In a mortgage, that sale is the sheriff's sale. It doesn't matter what they sell it for later on out on the real estate market. The sale is the sheriff's sale. And I'll tell you, still in this state, a majority of sheriff sales will go for what we call full debt bid. And those are the three key words you need to ask. After somebody goes through a sheriff sale, they need to call the attorney's office and say those three words. Did I get a full debt bid? And if the attorneys say yes, then there is no deficiency. And seriously, it's that quick of a phone call. I mean, you can call Trot in Orleans on any day of the week with a property's address and say, was there a full debt bid? And if they say yes, there is no deficiency. That person cannot be sued later on. If they say no, it was a stated bid, then you want to know what that bid amount was. Because if the lender went in with a stated bid, then that leaves a potential gap between what was actually bid and what was owed, and that's what can be sued upon later. And you do see it. I'm just saying you don't see it. A majority of cases are still full debt bids, but you will see some stated bids. And that's what people need to be aware of. If you get a short sale or a deed in lieu, which I'm going to talk about later on, the mortgage company has basically forgiven a portion of your debt. But the IRS considers any debt that's forgiven actually income to you. And there was a time when the federal government had, up until the end of last year, tax relief, saying we're not going to federally tax you on that. That law expired and has not been renewed. So now anybody going forward doing a short sale or a deed in lieu and is having a debt forgiven, they're getting federal taxes charged against whatever was forgiven. And you don't have any way of knowing whether you're going to get a full debt bid or a stated bid until after it happens. You know, people are always saying, can I call and ask? Your mortgage company will never be able to answer that question. The attorneys won't answer the question. So it's really nothing you can predict and nothing you're going to know until after it already happens. Whenever you're negotiating loss mitigation, and you guys won't be, but when you hear counselors talking about it, you can never negotiate loss mitigation from the standpoint of it's the right thing to do, that we want to save the neighborhood, that we want to help this family. It's all about the bottom line. I mean, that's what this comes down to. You've got loss mitigation is specifically what those words say. They are trying to mitigate their loss. They're trying to mitigate their financial loss. So whatever workout is offered, whatever option is being presented not because it's pulling at the heartstrings, but because on paper, on the computer, it shows that financially, that's the best business decision. And that's where loss mitigation comes from. And that's where loss mitigation will always come from. Their marketing people will tell you different. But I'm telling you, the people who look at the spreadsheets and make the decisions based upon a business. The only caveat I will give is if you are dealing with a small local lender. If you're dealing with a small local credit union or bank, that can get personal. I prefer to deal with Bank of America over a small local credit union, actually. Because those small local entities can take things too personally, and it can negatively affect clients.